3,000 years of financial history, 3 global reserve currencies. Every single one collapsed after following the same 4-stage cycle. We are not talking about market volatility. We are talking about systemic failure. Look at the data. The US dollar index just hit 98.96, a 5-week low. It is down 7% year to date. This is not just a number, it is a flashing red alarm. Now, look at silver. It has doubled this year, up an astonishing 84% in 11 months, from $28.92 in January to $58.62 in December. This is not a bull market, it is a warning. It is the canary in the coal mine telling us that the financial structure we have relied on for 80 years is cracking. What is happening right now, this exact moment, has happened before. Rome, Spain, Britain. They all followed the pattern. We are deep, deep into stage 3 of the collapse cycle, the stage of crisis and loss of control. By the end of this broadcast, you will understand the unavoidable mathematics driving this collapse. You will know exactly what the world's most powerful nations are doing right now to prepare, and most importantly, you will know how to position your assets before stage 4, the inevitable outcome, arrives. Stay with me, because the end of this cycle always happens faster than anyone expects. We must first understand the mechanism. This is a pattern that defies military power, political promises, and technological advancements. It is purely economic. It is structural. Stage 1. Setup and foundation. A nation achieves dominance, not through sheer force, but through real economic production. They make things. They export things. Their currency is trusted globally because it is backed by actual, verifiable value. For ancient Rome, it was the engineering and the purity of their silver coin. For Great Britain, it was the world's first industrial factories. For America, it was post-war manufacturing that accounted for 50% of global gross domestic product. Trust is absolute. The foundation is solid. Stage 2. Expansion and debasement. Here is where the decay begins. The dominant nation discovers a seductive secret. Because their currency is locked into the global trade infrastructure, the world will still accept it even if they start printing it without the corresponding backing of production. Wars, empires, social programs, and deficits pile up year after year. The currency is slowly debased. The consequences are delayed, hidden from view. This stage feels like eternal prosperity. It feels like success. But it is a slow poison working its way through the entire system. Stage 3. Crisis and loss of control. This is where the math catches up. The deficits become unsustainable, the national debt becomes unpayable. To cover crushing obligations, the money printing accelerates. Other nations finally see the truth. They notice the core value is gone. They begin to diversify. They dump the reserve currency. This is the critical feedback loop. The trust breaks. What was slow debasement becomes rapid devaluation. Central banks try to intervene with rate cuts or more printing, but every intervention only makes the systemic problem worse. We are in stage 3 right now. Stage 4. The inevitable outcome. Total currency collapse or severe devaluation. Reserve status ends, global power shifts. For the masses holding assets denominated in paper currency savings accounts, fixed incomes, bonds, wealth evaporates. For the few holding real, tangible assets, precious metals, productive land, commodities, wealth concentrates and multiplies. History proves this stage happens fast. Once confidence breaks, it is a matter of months, not years, before the outcome is realized. To truly understand the danger of stage 3, we must look back 18 centuries. What happened to the Roman denarius coin between the 2nd and 5th centuries AD is not just history. It is a direct mathematical template for what is happening to the US dollar today. Stage 1. The purity of the denarius. In 200 AD, Rome dominated the known world. Its power was not just military, but economic. The denarius was the global reserve currency. Everyone trusted it because it was honest money. Stage 1 was solidified by its 95% pure silver content. This was the real value backing the currency. A soldier was willing to fight for it. A merchant was willing to trade goods for it. Stage 2. The poison of empire. As the empire expanded, its military campaigns and internal administration became astronomically expensive. The cost exceeded the empire's real tax revenue and production capacity. The temptation to debase the coinage became too great. Starting with Emperor Nero in the middle of the 1st century AD and accelerating rapidly with emperors like Caracalla, the state began to reduce the silver purity to finance its obligations. They melted down the old coins, added base metals like copper, and minted more coins. Look at the numbers. The 95% purity of the denarius was slowly chipped away. Asterisk. By the year 250 AD, the silver content had dropped to 50%. Asterisk. By the year 270 AD, it was down to just 5% silver. Each generation accepted a slightly less valuable coin because the Roman trade infrastructure remained dominant. This was the deceptive prosperity of Stage 2. The consequences of printing money were delayed. Stage 3. Hyperinflation and collapse of trust. The mathematics eventually asserted itself. By the 3rd century, the coin was nearly worthless. That 5% silver content was the tipping point. The velocity of money surged as no one wanted to hold the trash currency. The economic reality was devastating. A measure of wheat that cost half a denarius in 200 AD cost 200 denarii by 300 AD. That is a 400 times increase in price over 1 century. That is not inflation. That is currency destruction. The feedback loop became irreversible. Soldiers refused to fight for worthless metal and demanded payment in goods or pure gold. Workers demanded payment in kind. Emperors responded by printing, or minting, even more trash coins to pay the army, fueling hyperinflation further. Stage 4. The inevitable end. This crisis of confidence accelerated the decline. The economic foundation was gone. While the military stood for another century and a half, the currency had already failed. In 476 AD, the Western Roman Empire collapsed. The denarius vanished. Europe descended into a barter economy for 300 years. The reserve currency of the ancient world was extinguished by its own financial irresponsibility. The lesson is absolute. Military might cannot override the laws of mathematics and trust. The Roman collapse was a warning. The subsequent failures of the Spanish real and the British pound sterling prove that the 4-stage pattern is not tied to ancient empires. It is tied to financial morality and the iron laws of economics. The Spanish real production fraud. In the 16th century, Spain discovered the New World. Mountains of gold and silver poured into Seville. The Spanish real became the global reserve currency. Spain was the superpower, the empire where the sun never set. But here is the critical distinction. Spain became rich not through productive industry, but through extraction. They imported everything, buying all goods and services with New World silver. The money flowed out faster than it flowed in, enriching their trading partners, the nations who were actually making things. This was a classic Stage 2 trap. Spain substituted real production with monetary extraction. By the 17th century, the math caught up. Spain was importing inflation and exporting its wealth. Prices in Castile increased by 400% in 1 century. The silver mines eventually declined. While other European nations, like the Dutch and the English, were building productive manufacturing and farming economies, Spain was relying on a paper stream of metal. The crisis of Stage 3 hit hard. Spain devalued its currency multiple times and defaulted on its debts. Record-keeping shows 7 defaults in 70 years. Once the gold and silver influx slowed, the underlying weakness, the lack of real industry, was exposed. By the mid-17th century, the real was worthless outside Spanish territories. Amsterdam and London became the new financial centres. Spain's golden age was over, extinguished by a reliance on financial flow rather than economic substance. The British pound, the debt anchor. 2 centuries later, the British pound sterling ruled the world. Britain was the first to industrialise, dominating global manufacturing. The pound, backed by gold, enjoyed absolute trust. This was Stage 1 perfected. The pivot to Stage 2 was triggered by war. World War I forced Britain to suspend the gold standard and finance the massive conflict through borrowing and money printing. The numbers are staggering. Britain's national debt, which was £650 million in 1914, exploded to £7.4 billion by 1919. That is a 10-fold increase in 5 years. Britain attempted a desperate return to the gold standard in the 1920s at the pre-war parity. But the money supply had expanded too much and the debt was crushing. They were hemorrhaging gold reserves. Meanwhile, the United States had emerged as the true industrial giant, the real creditor, the real producer. Stage 3, the 25% devaluation. The pressure became unbearable. In 1931, Britain abandoned the gold standard entirely. The pound devalued by 25% overnight. Panic ensued. Other nations dumped their pound sterling reserves. The sterling bloc, which controlled global trade, crumbled. World War II finished the process. By 1945, Britain was bankrupt, indebted, and totally dependent on America. Stage 4 was officially recognized in 1944 at the Bretton Woods Agreement, which declared the US dollar the new global reserve currency convertible to gold. The pound sterling, which once ruled a quarter of the Earth's surface, was relegated to a regional currency. Same pattern, different century, different military strength. The outcome was mathematically identical. Excessive debt and the replacement of real production with fiat expansion guarantees collapse. For 80 years, the US dollar has stood as the pillar of global finance. Many argue that America is different, that its military, its innovation, and its sheer scale grant it immunity from the historical pattern. History tells us that this belief in exceptionalism is precisely the final symptom before Stage 4. The dollar followed the cycle perfectly. Stage 1, Bretton Woods and absolute trust. After the devastation of World War II, the United States was the undisputed industrial power. It controlled nearly 50% of the world's manufacturing capacity and held 2/3 of the world's gold reserves. The dollar's ascent to global reserve status was formalized in 1944 at the Bretton Woods Conference. Under this system, foreign governments could convert their dollar holdings into gold at a fixed rate of $35 per ounce. The dollar was trusted because it was literally as good as gold. The world needed dollars for oil, for trade, and for reconstruction. This was the pinnacle of Stage 1, built on genuine production and real value. Stage 2, the seduction of unlimited power. The turning point, the beginning of the slow poison of Stage 2, came in 1971. The escalating costs of the Vietnam War and President Johnson's Great Society programs drained America's gold reserves. Foreign central banks began to demand their gold back, recognizing that the US was printing more dollars than it had gold to back. On August 15, 1971, President Richard Nixon unilaterally closed the gold window. This move, known as the Nixon shock, officially ended dollar convertibility to gold. The dollar immediately transitioned from an asset-backed currency to pure fiat, backed by nothing more than the promise of the government and the might of the military. The secret was now unlocked. America could print money, and the world was forced to accept it. The US replaced gold backing with the petrodollar system. By ensuring that global oil trade, the lifeblood of the global economy, was conducted exclusively in dollars, the US manufactured artificial global demand for its currency, allowing it to spend without immediate consequence. The mathematics of debasement. The numbers since 1971 are the evidence of Stage 2 expansion and debasement. Asterisk. The national debt, which was only $370 billion in 1970, exploded to over $33 trillion today, and is projected to reach $36 trillion in the fiscal year 2025. Asterisk. The money supply, measured by M2, grew from $600 billion in 1971 to over $21 trillion today. That is a 35-fold increase in the paper currency supply over 5 decades, all while productive manufacturing capacity declined relative to the rest of the world. For 54 years, the world accepted this imbalance. But the consequences of this debt and printing are finally arriving. We are now seeing the inevitable transition from Stage 2's hidden erosion to Stage 3's visible crisis. We are no longer discussing ancient history or events 50 years in the past. We are living through Stage 3 right now. The difference between Stage 2 and Stage 3 is simple. Stage 2 is the slow accumulation of debt. Stage 3 is the moment the debt becomes mathematically unpayable. Pillar 1, the debt wall. We must look beyond the abstract figures. We must look at the obligations that guarantee accelerated money printing. The first number is the national debt. It is projected to hit $36 trillion in the fiscal year 2025. Think about that figure, $36 trillion. The second, and far more terrifying number, is the scale of unfunded liabilities. These are promises made that cannot be met through current taxation or economic growth alone: Social Security, Medicare, and Medicaid. The total figure for these future obligations is estimated to be over $135 trillion. These are not negotiable. They are legal and political promises that must be covered. How does a government cover $36 trillion in debt and $135 trillion in unfunded liabilities? There are only 3 options. Taxation. raising taxes to a level that would crush all economic activity. 2. Austerity, cutting spending on the military or social programs politically impossible. 3. Inflation, printing money to devalue the debt. History, logic, and political reality dictate that the government will choose option 3. The debt will be inflated away. Furthermore, consider the cost to service the debt. With interest rates at historically elevated levels, the annual interest payment on the national debt has already surpassed $1 trillion per year. Servicing the debt is now the fastest growing line item in the federal budget, quickly overtaking national defense spending. This is a feedback loop. More borrowing is required simply to pay the interest on existing borrowing. This is the definition of the Stage 3 crisis. The system is consuming itself. Pillar 2, the international revolt and the de-dollarization. For decades, the world was forced to accept dollars, despite the debasement, because there was no alternative. That is changing rapidly. This is the hallmark of Stage 3. Other nations recognizing the fundamental shift and acting to diversify. Look at the actions of the world's major economies. Asterisk, China's treasury dump. In 2013, China held over $1.3 trillion in US Treasury securities. By 2025, that figure has dropped substantially, estimated to be around $780 billion. This is a strategic pivot away from the US financial system. Asterisk, central bank gold buying. Central banks, the ultimate financial insiders, are buying gold at record rates. In the first half of 2025 alone, global central banks purchased over 818 tons of gold, a figure largely driven by nations like China, Russia, India, and Turkey. Gold is the anti-dollar. Their actions speak volumes. They are fleeing fiat currency and seeking hard assets. Asterisk, the BRICS movement, the alliance of Brazil, Russia, India, China, and South Africa, now expanded to include major energy producers like Saudi Arabia and Iran, is actively building alternative payment and trade systems. Saudi Arabia is accepting the Chinese yuan for oil sales. These are seismic shifts away from the petrodollar system established in the 1970s. The dollar index, or DXY, which measures the dollar against a basket of 6 major currencies, is the instant readout of this revolt. Hitting 98.96, a 5-week low and declining 7% year-to-date, is the direct result of the world voting with its capital to diversify. Pillar 3, the Fed's trap. The Federal Reserve is trapped in the center of Stage 3. They face an impossible choice. 1. Cut rates. If the Fed cuts interest rates, the dollar weakens further. Inflation, which has proven difficult to control, immediately returns, accelerating the debasement of the $36 trillion debt. Hold rates high. If the Fed maintains high rates, the cost to service the national debt accelerates further than the $1 trillion mark, virtually guaranteeing a brutal recession and potential default on obligations. There is no good option, only bad and worse. The market's expectation of the Fed's next move proves the direction of desperation. The market is pricing in an approximately 80% chance of a rate cut on December 10th next week. This action, if it occurs, will accelerate the dollar weakness, fuel inflation, and confirm that the Fed is choosing the debasement path. The mathematics are unavoidable. The historical template is complete. We have moved from slow, hidden debasement to rapid, visible crisis. This brings us directly to the signal that confirms everything we have discussed, the breakout in silver. If the plunging dollar index is the sound of the engine seizing, then the explosive rise of silver is the blinding flash of the warning light. Every historical currency crisis, from the Roman denarius to the British pound, was preceded by a flight to tangible assets, and today, silver is ringing the loudest alarm. The two drivers of silver's surge. The price of silver is being driven by a confluence of two powerful, independent forces, one industrial and one monetary, that guarantee sustained appreciation as Stage 3 accelerates. A. The industrial demand crisis. Silver is not just a monetary metal. It is essential for modern, high-growth technology. This industrial utility ensures that, unlike gold, silver has a demand floor that is constantly rising with global innovation. Consider the 5 major industrial uses driving demand. Solar panels. Silver paste is critical for photovoltaic cells. Global renewable energy mandates are creating relentless demand. 2. Electric vehicles. Silver is crucial for complex wiring and battery systems in EVs. 3. AI data centers. The explosion in artificial intelligence requires vast, sophisticated data centers, all utilizing silver in their components. 4. Nuclear reactors. Silver, indium, cadmium alloys are used in control rods for nuclear power generation. The statistics are clear. The world is facing an acute supply deficit. We are in the 5th consecutive year of supply deficit, meaning the world is consuming more physical silver than is being mined and recycled. Mine production is declining, while industrial demand surges. This guarantees that prices must rise to balance the equation. B. The monetary panic. This is the key connection to the 4-stage cycle. When confidence breaks in fiat currency, investors and central banks always pivot to tangible, historically proven money, gold and silver. The data confirms this panic. Asterisk ETF inflows. Silver-backed exchange-traded funds have seen massive inflows, adding 200 tons in a single day, reaching the highest investment level since 2022. This demonstrates institutional money fleeing paper assets. Asterisk physical disappearance. Inventories in major global hubs, such as the Shanghai Silver Exchange, are at decade lows. This indicates that physical metal is being rapidly taken off the market and stored by private individuals and financial entities who anticipate currency destruction. Asterisk the gold to silver ratio. Historically, the ratio of the price of gold to the price of silver narrows sharply during currency crises. This is because silver is a smaller, more volatile market. When the public finally recognizes inflation, silver moves faster and more violently than gold. The historical precedent for a silver breakout. This is not speculation, it is history repeating itself. During the last major currency crisis scare, from 2008 to 2011, silver climbed from $9 per ounce to over $50 per ounce. That was a 450% gain in 3 years. Today, silver has already broken out, climbing from $28.92 in January to $58.62 in December, an 84% gain in just 11 months. Analysts are now calling for $60 short-term and $75 by mid-2026. The most aggressive, yet historically grounded projections call for a price of $100 or higher as Stage 4 approaches. Why silver over gold? Silver benefits from both industrial and monetary demand, making its price movement amplified compared to gold during a combined industrial boom and a financial panic. The silver breakout is definitive proof that the world's smartest money is recognizing the unavoidable mathematics of the dollar's Stage 3 crisis. The flight from paper has begun. We must be clear, predicting the exact date of Stage 4 is impossible, but understanding its mechanics is essential. Stage 4 is not the US collapsing into chaos. It is the dollar losing its reserve currency status, triggering a massive, irreversible wealth transfer within the American economy. This process will likely unfold within this decade, certainly within 2. The return of real inflation. The first and most direct consequence of losing reserve status is the loss of the dollar's exorbitant privilege, the ability to export its inflation. When the world no longer needs dollars for oil and trade, those trillions of dollars held overseas will rapidly return home. This repatriated liquidity will collide with the Fed's debt monetization, creating a spiral of inflation unseen since the 1970s. We are not talking about the Federal Reserve's target 2%. We are talking about real inflation, sustained year over year at 10%, 20%, or possibly higher. This is the state's mechanism for defaulting on the $36 trillion debt without calling it a default. The end of cheap financing. When the dollar loses confidence, its value drops, and no foreign lender will finance the US government at near zero rates anymore. Interest rates will spike sharply. The government will be forced to pay significantly higher interest on its debt, diverting even more of the national budget away from essential services. Austerity will become forced, not chosen. The standard of living for every American holding paper, or fixed income, will decline. Every individual on fixed savings, every retiree dependent on a fixed pension will be devastated by the loss of purchasing power. The social contract will be broken by the mathematics of debt, the great wealth transfer. The core truth of Stage 4 is that wealth does not disappear, it transfers. This is the pattern observed every single time. Rome, Spain, and Britain. Asterisk. The losers, those holding paper-denominated assets, bank savings, corporate bonds, fixed income pensions, and dollars. Their wealth is consumed by inflation. Asterisk the winners. Those holding real assets that retain value regardless of the currency they are priced in. physical gold, physical silver, commodities, productive farmland, energy infrastructure, and water rights. When confidence breaks, the transfer is swift and brutal. Paper assets become worthless claims, while real, tangible assets explode in value because they are the only things left that are not simultaneously someone else's unpayable liability. This is the inevitable outcome of the four-stage cycle. The time to prepare for this transfer is not when stage 4 is declared, but right now, during the final, frantic stages of the crisis. We have decoded 3,000 years of history. We have seen the systemic pattern replay itself with the Roman denarius, the Spanish real, and the British pound sterling. And now, we've examined the unavoidable math, the $36 trillion in debt, and the $135 trillion in unfunded liabilities that confirms the US dollar is deep in stage 3. The silver breakout, the 84% gain this year, is not a market anomaly. It is the final, definitive signal that the world is transitioning from paper confidence to tangible reality. Military power does not repeal the laws of mathematics. Exceptionalism does not exempt you from the pattern. The outcome is inevitable. Wealth will transfer from those holding paper claims to those holding real assets. This is not investment advice. This is an historical warning. Your positioning must reflect this reality. Diversify meaningfully out of pure dollar exposure. Hold physical gold and physical silver assets that carry no counterparty risk. Secure productive assets like farmland or energy rights. The time for complacency is over. The dollar's 5-week low and silver's explosive rise are not coincidences. They are the beginning of the feedback loop. If this analysis has opened your eyes to the economic reality, subscribe now. In our next video, we will analyze exactly why the Federal Reserve's upcoming December 10th decision will accelerate every single trend you just witnessed. Do not miss it. Thank you for listening.